So, as you've seen, when it comes to recording long-term liabilities and payments made, there really isn't a ton that deviates from the norm. However, where things really change is the balance sheet. Some companies, for financial planning purposes, like to figure out what the total amount that will be owed on the note each year. You can use an amortization schedule to help you figure that out. I'll talk more about this in the next lesson. With that amount in hand, you can split that on the balance sheet, putting the amount owed in the next 12 months as a line item in current liabilities, and the remaining balance as a line item in long-term liabilities. What this does is help businesses plan ahead and know exactly how much they need to pay each year towards the liability. Here, let's take a listen to an expert with a bit more advice about working with long-term liabilities and the balance sheet.
In general, you would think a long-term liability would be recorded when you first get the loan in the long-term liability section of the balance sheet. That completely makes sense, right? Well, there are some companies who like to report in a different way. So let's take a 7-year loan, and the loan is $7,000. That means $1,000 a year is going to be paid off. If you think about it, on day one of that loan, the total loan is $7,000. $6,000 is long-term liability. $1,000 is actually a short-term liability because that portion of the loan will be paid off within the first year. So some companies like to have their long-term liabilities reported in this way. Our job as a bookkeeper would be to journal the current year's value of that loan from long-term liabilities to current liabilities. And I've seen people do recurring journal entries, one a year, that moves that value from long-term to current. And so basically, if you think about it, the balance sheet on year 7 shouldn't have any long-term liabilities, and that last $1,000 will be in the short-term or current liabilities section. So just keep an eye out for a client that wants to report long-term liabilities in both the short-term and the long-term liability. It's just the current portion for the current year gets moved to current. And hopefully that will help you get that booked.